4,000 years ago, a merchant in Babylon signed a contract on wet clay. It would make him rich. It contained one clause that could destroy his entire family. This is the story of the first bankers in human history, and the debt they invented, along with everything that came with it. Babylon, roughly 1800 BCE. A city of mud brick towers rising from the floodplain of the Euphrates, its temples plated in gold, its granaries stacked with grain that never seemed to run out. Here, for the first time, lending became a system. Interest rates were fixed by law. Contracts were standardized on clay tablets, sealed with cylinder seals, and archived by the thousands. A loan was no longer a favor between neighbors, it was an instrument. And the terms were steep before we even reached the twist. Silver loans carried 20% annual interest. Grain loans carried 33 1/3%, fixed, written into law, non-negotiable. That is the number to hold on to before we go further. At the center of this system sat the temple and the palace, Babylon's earliest banks. Priests and officials didn't just store grain and silver. They lent it out, tracked every transaction on clay, and collected on it with the precision of a modern ledger. Debt became infrastructure. And it worked, spectacularly. Trade routes stretched from the Persian Gulf to Anatolia. Merchants who could borrow could expand, buy more grain, hire more labor, move more silver across 1,000 miles of desert and river. Babylon's prosperity was built, quite literally, on credit. But the thing that made this system so effective, its enforceability, was also the thing that would make it so dangerous. A loan is only as good as what happens when it isn't repaid, and Babylon had already answered that question in writing before the ink, or rather, the stylus, was dry. So how did they enforce a debt when a debtor couldn't pay? They didn't send collectors chasing through the streets. They didn't usually seize land either. Land in Babylon was often tied to family or temple obligations, harder to liquidate. Instead, the standard Babylonian loan contract carried a clause that let a creditor take something far more valuable and far more personal than property. We'll come back to exactly what that clause allowed. Keep it in mind, it's the reason this whole system could scale the way it did, and it's the reason it eventually needed a king to intervene. Because for the merchant class, business was extraordinary. Clay archives from the period preserve thousands of ordinary transactions. Receipts for copper from Dilmun, tin hauled in from the east, textiles woven in Babylon's workshops and shipped out on credit against future harvests. One famous surviving tablet is a customer complaint about a bad shipment of copper, proof that 4,000 years ago, people were already arguing about quality control in writing. Every prosperous season made the system look safer than it was. Every bad harvest reminded borrowers exactly what they had agreed to. That reminder is where our story turns. By the reign of Hammurabi, the king whose law code would eventually try to rein this in, Babylonian households were borrowing against something the temple ledgers recorded in cold, specific language, persons. Under the standard loan contract, if a debtor defaulted, the creditor could take the debtor's wife, child, or the debtor themselves into servitude to work off the debt. Historians call this an anti-credit pledge, a human being pledged as collateral, laboring not to reduce the principal, but simply to service the interest, season after season. This wasn't the exception buried in some obscure clause. It was the fine print of an ordinary loan, the kind any merchant, farmer, or craftsman might sign to get through a bad year. And it explains something that seems, on the surface, almost absurd. A booming, sophisticated economy, arguably the most advanced financial system on Earth at the time, that could still, with one bad flood season, turn a family into unpaid labor inside their own city walls. The wealthier Babylon got, the more households had access to credit. The more households had access to credit, the more of them carried debt secured by their own bodies. Prosperity and vulnerability grew from the exact same root. That's the pattern historians keep circling back to when they study early debt economies. The instrument that generates growth is, structurally, the same instrument that generates bondage. Not a side effect, a feature. Something similar is quietly happening in at least one major economy today. We'll name it before we're done. Picture the mechanism in practice. A farmer near the outskirts of Babylon borrows grain in the spring, 33.33% due at harvest. The Euphrates floods late that year, or not enough. The harvest comes in short. The debt does not shrink to match it. The farmer has three choices, and Babylonian contracts made all three explicit in the wording. Repay in silver he doesn't have, repay in grain he doesn't have, or send a family member to the creditor's household to labor off the difference. Thousands of households made that third choice, not because they were criminals or failures or outliers, but because the system was engineered so that choice always existed as the fallback, a safety valve for the lender, a trapdoor for the borrower. And here's the myth versus data turn worth sitting with. The story we tell about ancient slavery usually centers on war captives and foreign conquest. The ledgers tell a quieter, more domestic story. A huge share of bonded labor in Babylon came not from Babylon's enemies, but from Babylon's own citizens, undone by their own city's interest rates. Word of this eventually reached the palace, not as scandal, but as a structural risk. When enough households across a kingdom are bonded to creditors, they stop producing for the state. Armies need farmers. Farmers who are indentured to a merchant's household for years at a time cannot be conscripted, cannot be taxed the same way, cannot rebuild after a bad season. A kingdom running too much debt bondage was, in a very real sense, running down its own future capacity, the seed of collapse planted inside the very prosperity that made lending so attractive in the first place. So Hammurabi did something remarkable. Around 1754 BCE, he issued a legal code, nearly 300 laws inscribed on a black diorite stele that still survives today, and buried inside it was an attempt to fix exactly the clause we've been circling. Here it is, finally, in full, under Hammurabi's code, a person pledged into debt servitude, themselves, a wife, a child, could be held for a maximum of 3 years. After 3 years, by law, they had to be released, debt or no debt remaining. That's the reveal, not the invention of debt bondage. That already existed, long before Hammurabi. The reveal is what Hammurabi's law did not do. It did not abolish the practice. It capped it. The most powerful king in Mesopotamia looked directly at a system where families were routinely enslaved for unpaid interest, and instead of ending it, he wrote a time limit into it. 3 years. That was the compromise a golden age settled on, not justice, a ceiling. And that single number tells you everything about how Babylon's economy actually worked underneath the gold and the trade routes. Debt bondage wasn't a crisis to be solved. It was a cost of doing business, negotiated down to a maximum term. What happened next moved exactly the way you'd expect, once a system is built to manage human collateral instead of eliminate it. The 3-year cap didn't end the practice. It normalized it. Later Babylonian and Assyrian records show debt servitude continuing for centuries after Hammurabi, sometimes extended through renewed contracts the moment the previous 3 years lapsed. The clause survived the king who tried to limit it, and it outlived his entire dynasty. Babylon's wealth kept growing, its trade networks kept expanding, and underneath that growth, an entire class of households cycled in and out of bonded labor, generation after generation, as part of the ordinary functioning of the city's credit system. They had the gold, the grain, the trade routes stretching 1,000 miles. They still built an economy where a bad harvest could cost a family their freedom. Here's the part that should unsettle you more than the ancient history does. The International Labor Organization estimates that tens of millions of people are living in situations of debt bondage today, modern debt servitude, where a person works to pay off a loan they can never quite clear, concentrated heavily across South Asia, in industries from agriculture to brick kilns to domestic labor. The mechanism is nearly identical to the one written on Babylonian clay 4,000 years ago: a loan, an inability to repay in cash, and labor substituted for money at terms set entirely by the lender. We didn't inherit the clay tablets. We inherited the claws. Babylon's temples are ruins now. The ziggurats have collapsed into low mounds of mud brick. The gold is long gone, melted down or scattered, and the merchants who built fortunes on 20% interest are names on tablets nobody reads outside a university archive. But the ledger they invented never really closed. Every time a modern debt contract quietly puts someone's labor, rather than their money, on the line, that's Babylon's clause, still being renewed. The first bankers didn't just invent debt, they invented the trade-off debt has always demanded. We just haven't decided, 4,000 years later, whether we're going to cap it or simply let it run.